To make an educated decision about the future, you gotta look to the past. What can past events tell us about what might happen? Because as the old saying goes, history might not repeat itself, but it often rhymes. So in this video, we're gonna talk about what led to the 2008 housing crash in America and what was the Fed's role in it. And we'll discuss if we're in for a similar ride coming up, or the most famous words of investing, will this time be different? So before we discuss what happened in 2008, what was the Fed's role, we got to break down what does the Fed do? What does the Federal Reserve do and what's its job so you understand what its role is and how it could impact it. The Federal Reserve's role really boils down to controlling inflation. It doesn't want to have inflation run too hot like we've been seeing for the past 2 years, but it also doesn't want too little. And it controls this really by interest rates. Lower interest rates will stimulate the economy, stimulate growth. Businesses will borrow money. They'll expand their businesses, create more jobs. This is stimulation. It's good to have a hot economy. But when it gets too hot and overheated and really too many people have jobs, people are making too much money. They're spending willy-nilly. They're buying Rolexes. The average Joe's buying houses they shouldn't be buying because they're uneducated. The Federal Reserve doesn't like that either. So what does it do? It raises interest rates to slow things down, creates pain, make things harder, more expensive. The regular Joe pulls back. They're not buying Rolexes anymore. They're not buying the $900,000 house when they should only be buying a $400,000 house based on their income and their job, etc. That is the Federal Reserve's job really in a nutshell. So what happened leading up to the 2008 housing crash? In the early 2000s, the Federal Reserve lowered interest rates to stimulate the economy coming out of the 90s and after the dot-com bubble. It was a pretty sad time. You know, I was only a child, but I've done my research. It was a pretty rough time. You know, jobs were hard to find. Housing didn't really move all that much. It was a flat, stagnant economy. And because of that, in the late 90s, early 2000s, the Federal Reserve lowered interest rates to help stimulate the economy. So in the year 2000, after the dot-com bubble, when things went a little wild, a little haywire coming out of the 90s, they raised interest rates to 6.5% in the year 2000 to help combat inflation and cool things down. Right now, the Fed rate is 5.5, so a whole percentage point than where we are right now. Imagine that. However, by the end of 2001, basically almost 2 years later, they dropped the rate to 1.75. From 6.5 to 1.75. And by mid-2003, it got to its lowest point of 1%. Now, obviously, with all of this low rates and stimulation this caused, businesses expanding, more jobs being hired, people buying houses like crazy, the economy was getting too hot. So the Fed started to increase rates again. And by mid-2006, rates were up to 5.25 again. So that's pretty restrictive territory. So what led to the 2008 crash was really the early 2000s, 2001 to like 2004, even 2005. Rates were very low. Lots of speculation was happening in the real estate community. People were buying houses like crazy, just like what we've seen for the past 2 years, really. Now, a little hint, you see how fast the Fed cut rates from 6.5 to 1.75 in just under 2 years. Now, the Fed today, for example, is saying, we're not going to do that. We're going to gradually lower rates. It's going to be higher for longer, and when we do start cutting, it's going to be gradual. But like I said many times, every single time in modern history where the Fed has raised rates this aggressive, and we went from like 0.25 to 5.5. That's like one of the most aggressive hikes, I think, almost ever, or in modern history. Anyway, every single time they've done that in the past, they come down almost just as fast as they went up. Almost every time. But the Fed today is saying, this time is different. This time is different. It's going to be a soft landing. We're going to slowly anyway, I can't predict the future, but based on past data, lie detector detected, that's a lie coming up. Maury Povich style, baby. Now, number two, what really led to the housing-specific crash in 2008 when everything kind of fell apart was subprime mortgages. Now, what's a subprime mortgage? Basically, think about it as a shitty mortgage. It's giving loans to people who should never got them. Subprime, suboptimal. You know, people that had low credit, no credit, their income shouldn't have qualified for the mortgage they qualified for. But in exchange, you know, they offered them higher interest rates. There's more fees. You know, these banks were saying, okay, because you have crappy credit, That sucks. We'll still give you a mortgage, but we're going to charge you more interest, just to make up for your lack of credit history. And the borrower went, yeah, sure, fine, whatever. Just give me the mortgage, man. Just give me the mortgage. I want that house in LA. I want the house in Malibu. Just give it to me, man. I got to look cool for all my friends. It's basically what happened in a nutshell. People were getting loans that should have never have gotten them. And by the way, that is very different today. Those lax rules are almost all gone. They're still there. There's still ways around it, but it's not like it was at all. So the financial industry really tightened up. And same thing for Canada. Canada has one of the tightest banking policies and institutions in the world. Literally, I'm not trying to brag too much because I don't really like Canada anymore. I'm planning to move to the U.S. very shortly and get our visa and stuff. But the entire world does look to Canada for stability in their financial sector. We're world renowned because in 2008, Canada didn't have a 2008. While America burned to the ground pretty much, Canada just slowed down and went a little flat. That's it. Nobody lost any money, really. Houses didn't crash. Why? Our banking system was totally different. To get a mortgage in Canada is insane. You have to provide so much evidence and detail. You have to qualify at a higher rate, 2% more for interest rate than what currently is available, just in case rates go up. We're a very tight country. America was just like giving them out like candy. So that's really why Canada or America really burned to the ground in 2008. And other countries like Canada, the European Central Bank, they didn't do too well. But Canada, really, Australia, we didn't really have a 2008. Which leads to my next point, number 3, monetary policy. Because the Fed lowered rates so much and so aggressively, it just created speculation. People want to jump in the housing market after 4, 5, 6 years of being constricted, not being able to move up to the next house they wanted. When these rates came crashing down super fast, people were like, this is the time, run, buy the houses. And you have a bunch of uneducated Joe Blows talking about real estate. Oh, my buddy just bought a house in this area. Oh my God, I have to buy something ASAP. It just creates FOMO. And that was the most FOMOist time ever. And the Fed played a role in that from lowering rates so low so fast. So it has to take responsibility for causing almost all of 2008 because that was a real estate specific problem. Number 4, federal oversight in the financial industry. Again, going back to my last point about how Canada was tight with their lending policies. You have to qualify at these rates. You got to provide this credit score has to be minimum of this. America didn't have any of that. They've totally rehauled that, like I said. But at that time, there was very lax regulations in the financial industry and what banks could do, what they could lend on, who they can give mortgages to. It was like the Wild West. Now, the next thing that also really caused the 2008 crash was a securitization. Try and say that. Securitization of mortgages. What basically means is hedge funds were packaging up bullshit loans, all of these subprime loans, into a portfolio and selling those portfolios as bonds or investments to other hedge funds or other investors to buy into. So they packaged them up and made it look like, well, hey, there's less risk. Because we're packaging up all of these thousands of loans, the odds of all of them going bankrupt are, less. So that's going to increase the stability, right? It's going to, it's more diversified. You should invest in these. They were obviously offering insane rates. So you had people buying these, investing in these, packaging up the packages and selling the packages and packaging up that package and selling. It was a gong show. I don't think even people understood that these were subprime shitty mortgages. They made it look so good, made it look like a AAA hedge fund, AAA package, and it wasn't. It was bullshit. Again, those laws have completely changed. So when shit hit the fan and the crash was coming, what was the Fed's response? What did the Fed do for monetary policy? What do you think they did? They lowered interest rates again to stimulate the economy, to back for another ride. But that's the tools they have to use, right? When we have mass unemployment, mass job loss, people are losing their houses, bankruptcy left, right, and center. That's a bad time. You got to stimulate the economy. What do? Lower rates. So that's what they did. Now, the impact on real estate directly from that created the next buying phase, the next cycle, right? Real estate cycles are a cycle. Up, down, boom, bust. It's a cycle. We're seeing it right now in real time. We just had a boom from 2020 to 2022. Now we've had a correction and a bust, really. It might not feel like it. It's not like 2008, but it's a bust from 2022 to 2024. It's heavily believed that right now in America is the bottom of the real estate market. This is pretty much it. With the Bank of Canada lowering rates, the European Central Bank now lowering rates, America's next. There's no secret about that. What happens every time we have the beginning of the down cycle? It's preparing for the next frenzy. Obviously, with rates at 5.5%, that's not too attractive. But when they get down to 3%, then 2%, maybe, that's going to create it all over again. People are going to start buying real estate. It's going to become cool. We're talking 2025, 2026, 2027. That's going to be the next rebound. That's what's being widely predicted anyway. And based on past data, why would this time be any different? The real estate market is going to go up again. It does every single time. So if you were waiting for this giant crash, like I always say, you just missed it. That was it. The past 2 years was it. Not every cycle down is a 2008. 2008 was very special. It's a perfect storm of shit. Lots of things were set up for that. A lot of those things are fixed. The subprime mortgages, the bad loans, the giving out money too much. There was pain, right? Prices did come down in most of America, 15, 20%. That's the definition of a crash. 20% is a crash in real estate terms. In stock terms, 20% is a correction. 50% is a crash for stock terms. We just had it. That was it. That's pretty much it. Will prices go down from here to Christmas? Maybe a little more, maybe. But that's pretty much it, dude. The next cycle will start. So let me know your thoughts. Did I miss anything? Should I talk on anything else? And what are your thoughts, most importantly? Leave them in the comments. Let me know what you think happened or what's going to happen, more importantly, in the months to come. I'd love to hear it. I'll see you in the next video.